Welcome to Iron Financial, where we forge stronger portfolios and cut through the market noise. Today we're putting IBM under the microscope. Big Blue just dropped its Q4 numbers, and the market went absolutely wild. Now, for a company that has spent the better part of a decade kind of wandering in the wilderness, this kind of explosive reaction, well, it demands a much closer look. We've seen way too many false dawns from this name before. So the question is simple. Is this a real structural rebuild where every single beam and rivet has been stress tested for the future? Or is this just a fresh coat of paint on an old building with a foundation that's still fundamentally cracked? Let's dig in and find out.
Well, that's a bold statement right from the top. CEO Arvind Krishna is projecting pure, unadulterated confidence after these results. He's not just talking about one good quarter, he's deliberately setting the tone for the entire year ahead. He's basically signaling to the market that all that heavy lifting, the painful restructuring, the years of transformation, that part's over. Now it's time to build upwards.
And Wall Street? Well, they reacted strongly, sending the stock soaring nearly 8% in after-hours trading. I mean, that is a massive move for a behemoth with a market cap north of $270 billion. A move of that size tells you one thing very clearly. The market was completely caught off guard. But here's the thing. Hype doesn't build a portfolio. Hard numbers and a sound structural analysis do. That pop is gratifying for current holders, sure, but we need to know if the structure can actually support a higher valuation for the long haul.
So here's our blueprint for today's deep dive. We'll start with the headline numbers that caused all this excitement, and we're going to construct the bull case, piece by piece, looking at the strongest load-bearing parts of the business. And then, once that shiny new structure is built, we're going to stress test that case. We'll be looking for hairline fractures and weak points the market might be ignoring in all this excitement. After that, we'll inspect the AI engine they claim is powering this entire machine, analyze the 2026 guidance they've laid out, and finally, deliver our verdict.
Okay, let's dive right into this first section, the breakout quarter. And I have to say, on the surface, the numbers are undeniably impressive. This isn't just a slight beat over what the analysts predicted. This is a clear, powerful signal that something fundamental may have finally changed within the company's core operations. So let's lay the cornerstone of the bull argument. First up, Q4 revenue hit $19.7 billion. That's a solid 12.1% year-over-year growth, absolutely smashing analysts' estimates of $19.2 billion. Look, for a company of IBM's colossal scale, hitting double-digit growth is like turning a container ship on a dime. It's a significant outperformance that shows broad-based strength across the business, not just a one-off win in a single, narrow niche. This is the kind of top-line number that makes even the most cynical analysts sit up and pay attention.
And that strong performance flowed directly to the bottom line, which is where it truly matters. Adjusted earnings per share came in at $4.52, another clean beat against the Wall Street consensus of $4.29. Now, this is a crucial detail because it demonstrates that the revenue growth wasn't just, empty calories bought with discounts. No, they're delivering profitable growth, and that's the only kind of growth that long-term investors should care about.
And here's the number that is driving the entire narrative. The figure everyone is talking about, a generative AI book of business now standing at over $12.5 billion. A year ago, this metric was barely a footnote. Now it's the headline. It has more than doubled in the last year alone. And what's critical to understand is this isn't just a pipeline of vague promises. It's a concrete mix of software sales, recurring SaaS contracts, and high-value consulting engagements. This figure represents enterprises moving past the AI experimentation phase into full-scale production deployments. This is the core of their growth story, the new engine they believe will power the entire structure for the next decade.
Okay, now let's build the foundation of the bull case. The real strength isn't just in the headline numbers, but in the specific segments doing the heavy lifting. A solid structure needs multiple strong support pillars, not just one. So where is this growth really coming from? We need to look at the schematics. Is this a balanced, healthy expansion, or is one part of the business simply compensating for persistent weakness elsewhere? Let's break it down.
Now, what's really interesting when you look at the table here is the actual composition of that growth. This isn't a story about the consulting business, which came in at a familiar, sluggish 3%. For years, that was the story we got used to. Instead, look at the two main pillars of the business. Software is up a massive 14%, hitting $9 billion in the quarter. And infrastructure, the old, supposedly dying hardware business, is rocketing up 21% to $5.1 billion. These are the high-margin, load-bearing parts of the business. This is exactly the revenue mix you want to see as an investor, a decisive shift toward more profitable, strategically important revenue streams. Now, drilling deeper into that powerful software segment, you can see the engine room. Red Hat, the absolute centerpiece of their hybrid cloud strategy, delivered a solid 10% growth. But the real power came from automation and data and AI, up an impressive 18 and 22% respectively. This is where the company's AI strategy crystallizes into actual reportable revenue. It shows AI integration is happening inside the core workflows of their customers. It's one thing to sell a simple chatbot, it is another thing entirely to sell an AI-powered automation platform that saves a global bank millions of dollars in operational costs. But what about the hardware? That 21% jump in infrastructure feels like an anomaly we need to understand.
The mainframe isn't dead. In fact, it has been reborn as the engine for their hybrid cloud strategy, especially for their largest, most security-conscious enterprise clients. And this number is simply staggering, a massive 67% year-over-year growth in the IBM Z business. This demonstrates robust adoption of their next-generation platform, which was specifically designed for the intense demands of on-premise AI workloads. So the crucial point here is that the core business, both new and old, is firing on all cylinders.
Okay, the bull case is laid out. It's a shiny new structure, impressive from almost every angle. It is compelling, but now it's time to play inspector and look for the cracks. Every perfect blueprint has a potential point of failure, and it's our job to find it before it finds its way into your portfolio.
A single great quarter does not erase a decade of sluggishness and underperformance. The market has an incredibly short memory, but a portfolio has to endure for the long term. We have to ask the hard question. Was this a fundamental shift in the company's trajectory, or was it just a perfect storm of a new mainframe cycle and peak AI hype? Let's put this incredible growth number into its proper context. Yes, 12.1% is a fantastic number for a single quarter, as you see on the left here. No one can dispute that. But when you zoom out and look at the right, the 5-year compounded annual growth rate is a much more mediocre 4.1%. This tells a story of long-term stagnation. So the billion-dollar question for any investor is whether this quarter marks the start of a new, steeper growth curve, or if it was a one-time surge driven by a mainframe refresh cycle and customers rushing to sign AI deals. Sustainability is the real test of a solid foundation.
And while revenue was way up, let's look at something that was down. Operating margin. As this chart shows, it actually compressed, falling from 22.3% in the same quarter last year to 21.1%. It's a small dip of 120 basis points, but it's a critical detail. It tells me this growth is not coming for free. IBM is spending heavily on R&D, acquisitions, and sales to secure these wins, which is putting real pressure on profitability. You have to wonder how long they can sustain that level of investment.
That spending is the cost of transformation. They have been making major, company-altering acquisitions to build out their capabilities in hybrid cloud and AI. You simply cannot rebuild a company of this size without significant capital investment. That margin dip is the price you pay for future growth. And that brings me to the enormous weight on this entire structure, a total debt load of over $61 billion. That is a massive liability. It's the steel frame they've used to build this new skyscraper, but it has to be serviced, quarter after quarter, no matter how the AI business performs. If there's an economic downturn or if the synergies from these acquisitions don't materialize as planned, that debt quickly becomes a crushing anchor, not a growth engine.
But that debt isn't random spending. It's a calculated investment in building a very specific kind of machine. It's right to point out the risk, but you also have to analyze what they actually bought with that money. Let's look at the engine they've been methodically building because it is the heart of the entire bull thesis.
This is a story of deliberate construction, not a haphazard shopping spree. It started with Red Hat, which gave them the foundational open-source hybrid cloud platform that can run anywhere. Then, in 2024, they acquired HashiCorp to add the critical orchestration and control layer, allowing businesses to manage incredibly complex multi-cloud environments. And the most recent piece of the puzzle, the massive $11 billion deal for Confluent in late 2025, that one definitely raised some eyebrows on Wall Street due to its price tag, but Confluent is the final, crucial component. It solves the data and motion problem. Most AI models today are trained on static data at rest. Confluent allows real-time streaming data from across an entire enterprise to be fed directly into their Watson X AI models. And this brilliantly illustrates the endgame they're playing for.
They are strategically moving past simple chatbots and into what is called Agentic AI. This is the next frontier. We're talking about autonomous AI systems that can execute complex, multi-step workflows without a human in the loop.
Think of an AI that doesn't just answer a customer's question, but actually processes their return, updates the company's inventory system, and issues the refund all on its own. These advanced systems need that real-time data from Confluent to function effectively. So the argument is that they've built a powerful competitive mode by owning the full stack. From the cloud platform with Red Hat, to the management layer with HashiCorp, to the real-time data streaming with Confluent, all feeding their own proprietary AI models. It is a compelling blueprint, but history is littered with grand acquisition strategies that failed because integration is where these plans so often fall apart.
That's a fair point. Integration is always the biggest risk factor on a strategy like this, but management seems confident in their ability to execute, and they have put their credibility on the line with their forward guidance. So let's look at the blueprint they've laid out for 2026. This is where the promises have to meet the pavement.
The guidance they provided is solid, and more importantly, it looks achievable. They're forecasting revenue growth of more than 5% in constant currency. That is above their recent historical trend of 4.1%, signaling that management firmly believes this quarter's strength is sustainable. On top of that, they're guiding to another $1 billion in free cash flow on top of an already strong 2025. The consulting detail here is key. The fact that 80% of their $12.5 billion generative AI book of business is comprised of consulting services is very telling. It shows that companies aren't just buying a piece of software off the shelf. They are paying IBM premium consulting fees to deeply integrate these AI systems into their core operations. That makes their solution incredibly sticky and much harder to rip out and replace with a competitor's product.
And this, right here, is the ultimate measure of financial strength. Forget adjusted earnings for a moment. Cash is king. As this chart clearly illustrates, they generated a massive $14.7 billion in free cash flow in 2025. Now, they are guiding to around $15.7 billion for the upcoming year. That is the money that pays down that $61 billion in debt, funds future acquisitions, and returns capital to shareholders through their century-old dividend, which they have paid consecutively since 1916. For a company undergoing such a massive transformation, having a growing mountain of cash provides an enormous margin of safety. It is the metric that matters most, and it is pointing definitively up.
All right, we have laid out the bull case, we have inspected the architecture, we have stress-tested the weaknesses, and examined the forward-looking blueprint. It is time for the final verdict. Is this a well-engineered opportunity or a beautifully disguised trap for investors?
So it all comes down to this. On one side, as you can see in the left column, you have a solid foundation built on real double-digit revenue growth in the high-margin segments of software and infrastructure. You have a booming $12.5 billion AI business with a clear strategic vision, and it is all supported by a cash-generating machine poised to produce over $15 billion this year. On the other side, in the right column, you have the fault lines, a decade-long history of underperformance that cannot and should not be ignored, a massive $61.3 billion debt pile that constrains flexibility, and the critical question of whether this blowout quarter was an anomaly or the new normal. The margin pressure also indicates this growth is expensive to achieve. Our verdict? The evidence points toward a genuine turnaround. The strategic acquisitions, while expensive, have created what appears to be a defensible moat in enterprise AI by controlling the entire stack. The growth in software and infrastructure is real, and it is being driven by a powerful new product cycle in both mainframes and AI. Most importantly, that robust free cash flow provides a powerful safety net to service the debt and continue investing for the future. This does not appear to be the IBM of yesterday. The heavy lifting has been done, the primary risk now shifts from strategy to execution. The blueprint is sound, but now they have to build it perfectly. Given the numbers and the clear path forward, this appears to be an opportunity, not a trap.
We've given you the analysis. We have shown you the load-bearing walls and pointed out the potential stress fractures in the foundation. Now, the final call is yours. Do your own homework. Stress test these assumptions for yourself. We'll see you next time on Iron Financial.